Good evening. On behalf of the ESG Committee of the CFA Society France, welcome to the second panel of the climate series, How to Implement a Low Carbon Strategy. My name is Gabriel Huet. I've been involved on financial markets for more than 20 years, and I'm currently work for Natixis as a credit trader. I've been leading the ESG Committee for 2 years now. I would like to introduce you Clarisse Simonek, who is an active member of the ESG Committee and the main contributor to the organization of this series of events. Clarisse has been working in responsible investment in the past 10 years and is the academic advisor and co-author of the CFA ESG Investing Certificate. We are both of us delighted to open this debate tonight. Before starting, a few words to remind you what is our committee and why we organize this event. The mission of the ESG Committee is to support the members of the CFA Society France on topics related to ESG issues. The committee supports members on training and skills issues, organize knowledge sharing, is a meeting place for members, and establish and maintains a network on ESG topics, and represents the voice of the French community in public consultations on ESG issues. So why this panel tonight? A few weeks ago, we hosted the first panel of our climate series, where we dealt with best practices and methodologies. We heard some experts telling us about ways of implementing a 2 degrees portfolio alignment and how the engagement policy takes place in the success recipes. We closed the debate on a dynamic tone, don't be scared to jump in the cold water. Tonight, we will focus on asset owner perspective and green products, as we wanted to start the discussion from the specific needs of asset owners and decipher how the financial industry can bring solutions or opportunities to feed these needs. The main points that will be addressed during these debates are how asset owners are building low carbon portfolio and what are the implications for asset managers. What are the characteristics of 2 degrees aligned index and their use, and a spotlight on green bonds market and its challenges. So I am pleased to introduce you our panelists. To represent the voice of asset owner, we welcome Joël Proin, Head of Investment Management at Caisse des Dépôts. For the climate index expertise, Florent Muller, Strategic Initiative at Solactive. And for the green bond expertise, Christopher Wegley, green bond specialist acting as an independent advisor. Each panelist will share a piece of his knowledge and experience and then answer any question you may have during a Q&A session. Don't hesitate to ask your question during the debate on the chat. So let's start. Clarisse, the mic is yours.
Thank you very much, Gabriel, and good evening, everyone. Thank you for joining us tonight. It's an absolute pleasure to have the honor really to moderate this panel with really distinguished guests who are all of them very active in the space of climate change, across different parts of the value chain. And with no further ado, I'll turn to the panelists to introduce themselves, their roles, and share a little bit of their thoughts on how the industry and their part of the industry is integrating climate change in investment decision making. So Joël, if we may, perhaps we can start with you with the all roads lead to Rome, as they say, and all roads lead to asset owners and their demands. So please share a little bit of your role and your thoughts on how the industry is dealing with climate change from an asset owner perspective.
Thank you very much, Clarisse. Just to introduce myself, my name is Joël Proin. I'm head of investment management at Caisse des Dépôts. Caisse des Dépôts is a public French institution, and we have as institutional assets under management of 190 billion of euros. I'm responsible of a team of roughly 90 people, and we manage more than 95% of our assets internally at Caisse des Dépôts. So we have fixed income teams, equity teams, real estate teams, but we delegate externally our private equity, infrastructure, and debt funds, and also some minor expertise on which the size of the assets are not sufficient to manage them internally. In fact, Caisse des Dépôts is a key actor in France in this respect. And besides my personal role at Caisse des Dépôts, I'm also a president of the Responsible Investment Commission of the French Association of Institutional Investors, called AF2I. And so I have two caps to share with you some concerns about climate issues and what asset owners are doing on this area. As far as Caisse des Dépôts is involved, of course, we are very active on this area, and we have been very active for now a very long period of time. In the middle of the years 2000, Caisse des Dépôts launched a subsidiary called CDC Climat, fully devoted to these climate issues. And at the very beginning of this issue, when it kicked off, in fact, this subsidiary was split in two parts. One was spun off in a dedicated think tank, fully supported by a group of investors, among which the largest one is Caisse des Dépôts, called Institute for Climate Economics. And I'm proud of being part of the board of this think tank. And the think tank issued a lot of papers to give public and private managers the opportunity of deciding on what are the most relevant issues on climate and economics. And in year 2015, a very famous year where took place the COP21, Caisse des Dépôts was the founding member of the Climate Finance Day. Now we had our sixth Climate Finance Day this year, but at the very beginning it was the EIB and Caisse des Dépôts who decided to jointly to set up this annual conference, which is a very important one. It gives milestones year after year on how to progress on these issues. And of course, in a fully consistent way with this personal commitments, I would say Caisse des Dépôts is also part of a lot of initiatives, and most of them flourished just before or after the COP21, and it's an ongoing process. And we try not only to act ourselves by ourselves, but also to group other investors with us in order to be stronger, in order to be more efficient, and in order to, in fact, push forward the whole bunch of asset owners in this climate war. To some extent, we are fighting because it's a very urgent issue. And I'm happy to share these concerns with a growing number of also other institutional investors around the world, and also in France, even if France is a bit of forerunner thanks to Article 173 and all the concerns we have in France. But now the pace is given, and more countries, more and more investors are also joining this journey.
Thank you very much, Joël. And certainly one of the big explosions in this aspect of climate has also been the green bonds market. So Chris, I turn to you, and if I may invite you to introduce yourself and speak about your experience in this market, which has been breaking records constantly, and including in the COVID time has really been an inspiration as well, its structure for, you know, other kind of bonds. So please, over to you.
So thank you very much, Clarice, and hello everyone. So yes, I've been an ESG fixed income portfolio manager for 16 years now. Responsible investment always used to be focused on equities, but I like to think that from 2004, I helped pioneer fixed income ESG integration and engagement from a bond perspective, and also investment in green and social bonds from 2006 and 2007. In 2014, I was recruited by Moreover in Paris to lead the Green Bond Project. And in 2015, I designed, launched and managed the world's first multi-currency, multi-credit rating global green bond fund. There had been two other green bond funds before that, but one was only in a single currency, and another was just restricted to AAA. So this was the first time we'd had a multi-currency and multi-credit rating global green bond fund. And then I followed that up with two more very similar in 2016 and 2017. And now I'm independent, providing guidance on all sustainable bonds, including COVID-19 social bonds, which, as you say, have been very relevant this year. Just with regards to the green bond market, of course, green bonds finance green projects, particularly renewable energy, energy efficiency, green transportation, etc. And it's said that there's no green asset that has more impact than a green bond. And we know, for example, that some equity funds include green bonds just to reduce their overall carbon footprint. And with regards to latest developments, we know that we have COP26 coming up in the UK in November. And the UK government have said they'll be looking to launch maybe up to 3 green gilts. And this follows on from a trend really of sovereigns issuing green bonds. So this year we've had Germany issue 2 green bonds and Sweden 2, following on from the likes of France and Belgium and the Netherlands. This year's been a very important year for diversification, as you indicated, Clarice. We've had the EU launch 40 billion in social bonds, with another 60 billion expected to come, all part of the measures to address the impact of COVID-19. Plus, next year we're expecting the EU to start launching over 200 billion euros of green bonds as part of the EU recovery plan as well. So what we're seeing in the market is a wide range of green bonds and social bonds and sustainability bonds and sustainable bonds. And today what we're talking about is portfolio construction. And I've noticed a new trend emerging here, which I'd like to outline to you very briefly. I've actually seen what I think are 3 models emerging in sustainable bond funds. We all know that alpha in fixed income comes from 4 key sources: duration management, term structure, allocation, and security selection. And the 3 models I've seen are, there's the full range model, where alpha comes from duration management and term structure, etc. We have to bear in mind that these are not necessarily sustainability, they're more mainstream. And sustainable bond funds are called sustainable bond funds because of their constituents. A second model, which I'm sure Clarice is more familiar with, is the alpha coming from allocation, or if you like, maybe smart beta funds or systematic investment. So we know with green bond funds, they can be looked at according to their allocation to regions or to subclasses like governments and investment grade, but also to industry sectors. And this new emergence we've seen is investors actually using quantitative data to decide the allocation by industry sector. So it could be low carbon, for example, or it could be carbon reduction. But we also have to bear in mind valuation, that's important as well. And the third model is purely security selection. So using ESG analysis to inform investment decisions to try and select those companies that are going to be the sustainable performers of tomorrow with spread compression. So they're the 3 models I've seen emerging recently, which I find quite exciting. And what I would like asset owners and clients to do going forward is to always ask asset managers for the attribution analysis on the funds, going back maybe 5 years or so, so there's a good history there, and then to focus on security selection and maybe allocation as the drivers of alpha using sustainability. Thank you.
Thank you very much, Chris. And I think it's fantastic that today asset owners can ask that we do have a history now of that asset class really being incredibly well established in the market. There's a new entrant to the market, you know, which is very much a result of, you know, the infamous taxonomy, let's call it that, as it comes with challenges as well. But there's definitely been a lot of significant and relevant innovation that has yielded from it, and it certainly opens the gate of green products that now is able to go beyond bonds and into equities, and certainly can be hopefully quite disruptive as well in contributing to low carbon economy. So on that note, Florian, if I may invite you to speak a little bit about your world of indices and Paris-aligned products.
Thank you, Clarisse. I'm very happy to be here. My name is Florian Müller. I'm a senior associate in Selective's strategic initiatives team. Selective is a Germany-based index provider. We are operating on a global scale, are hopefully known to a lot of participants today already. We were founded in 2007, and our focus has been and still is creating tailor-made multi-asset indices for our clients, which include investment banks, asset managers, ETFs issuers across the globe. And what I have started out as is on the product development side here at Selective a couple of years ago, and I was basically experiencing the trend shifting towards ESG strategies being requested by our clients, being looked into by our clients, moving from a niche topic to a trend that I think is topping the charts this year. We are calculating, as of today, over 200 ESG indices. We have overall 450 ETFs linked to our products that are not only ESG indices, obviously, with about 200 billion US dollars linked to those ETFs. Globally, I think, and also to put us in the ecosystem of, the index providers that most people know, we haven't been focused on brand management and brand creation, but rather on a technology-driven way towards indexing, which is eventually reflected in also a competitive pricing model. Yeah. What I'm here to talk about today, and that is what you mentioned, is some recent trends that we have seen on the indexing side, and that is almost by definition the passive side of the ecosystem, especially from the European Union, which introduced actually last week on a final note, the final regulations introducing two new kinds of benchmarks, the EU Paris aligned benchmarks and the EU climate transition benchmarks. And to give a brief overview over before I give a brief overview over these, we are already seeing first products in the market being launched on those new kinds of EU benchmarks. We are seeing here at Selective an increased interest in those solutions. So today I'm happy to answer any questions with regards to those solutions and provide a quick overview, what those solutions are built for, how an index provider like Selective tackles the creation of these portfolios, what's actually in those portfolios, how do they line up against their benchmarks, all these questions. And yeah, I think that's about it from my side for the start.
Thank you very much, Florian. And I guess what comes to mind is that there's such an advancement of, different ways that asset managers can advance on climate and integrating it with portfolio construction, being through ETFs of indices, green bonds, etc. So Joelle, I turn to you. Obviously, CDC is a member of key industry initiatives such as the Net Zero Asset Owner Alliance, among others, many of which you guys have developed yourselves, which I imagine is only seeing the level of ambition grow as innovation comes out in the market. So I guess the question is, what do you see as the expectations today that asset owners generally have with regards to how managers mitigate climate risk and contribute to mitigation in the real economy?
In fact, to answer your question, I think that the ultimate responsibility lies on the asset owner side. Because, of course, our asset managers could provide us with the full range of products, but if we don't buy them, if we don't invest in these products, if when we manage internally our assets, we don't go to a greener and most sustainable portfolio, it has no effect. So, in fact, there is the supply and the demand side. And Caisse des Dépôts, as you mentioned rapidly, is a founding member of the Net Zero Asset Owner Alliance. And I just take 1 or 2 minutes to describe a little bit what it is about. This is an alliance which groups now more than 30 large institutional investors around the world. I can name Allianz, AXA, Generali, Aviva, CalPERS in the States, CDPQ in Canada, and a bunch of others. So large institutional investors fully aware that climate issues, it's a key problem in front of us. And we group ourselves in order to have a more efficient impact on the whole economy. Because I'm fully persuaded that it's very important to invest in impact funds, in impact assets, but it's also important to shift the trillions. And that's what we have decided to do. We fixed ourselves the target to be net zero green gas emissions in 2050, which is another way to say that we are fully aligned with the Paris Agreement. The experts make the equivalence. I don't enter into the details with this zero target in 2050 and the 1.5 degree target the Paris Agreement decided to adopt. And how could we achieve this goal? There is an easy way, but we don't want to follow it. The easy way is to divest, to sell our brown equities, our brown bonds to other investors. But the problem is that as investors usually don't care about climate as we do. So globally, it doesn't change anything. The second way is to engage the companies. And that's the way we decided to follow, to engage very thoroughly the companies we are invested in order to ask them to adopt a science-based trajectory towards this objective of net zero in 2050. And there is also the context in which we operate, all of us, companies, asset managers, asset owners. And so the policies, the regulations, the government decisions we have to work with. And that's the third way, in fact, we operate within this alliance, is to engage also the policymakers, the government, jointly. And it's easier to do it jointly because we are a bunch of institutional investors coming from the pension fund world, the insurance world, the public world, and private world. And so to engage the governments and the policymakers in order to adopt frameworks favorable to this goal we pursue. And in fact, I would also stress the point that it's an asset owner alliance. So there is no marketing afterthought, I would say. In fact, we don't want to sell something. We want to be able to work and to manage in a workable world. And that's a goal we pursue. And of course, we fixed milestones. And in the beginning of next year, we will fix a first milestone in 2025, because 2050 is far away. So we have to fix regular milestones every 5 years in order to set ourselves targets and to engage more efficiently the companies. Of course, we are doing it jointly with other initiatives already existing. I mentioned Climate Action 100+. A lot of asset managers are also part of this initiative, and we pursue the same goal. So we are not alone. But I would say that this alliance it's an overarching initiative, which is at this date the most exigent one, the most severe one, I would say, to fix ourselves this goal in 2050. And of course, we count on our asset managers, we count on our regulators, we count on everybody to achieve this goal, because it's a joint effort, otherwise it wouldn't success.
Thank you very much. And I think it comes back to that issue that we discussed briefly of the asset manager, the asset owner really being the driver of the industry in terms of the selection that they make of the products and the ambition in those. And I imagine, Chris, perhaps turning back to you, one of the very helpful building blocks that I believe these asset managers have at the end of the day are green bond portfolios as well. And very interestingly, we've seen some asset owners look at green investments as a hedging of the climate risk that they're taking on the rest of their portfolio, as we've seen with the New York pension funds. So, we mentioned that these have been around 5 years ago, and I imagine that in the beginning, when you mentioned the first fund being launched with multi-currency and multi investment grades, perhaps diversification and liquidity were a challenge. I'm wondering where are we now? Do these continue? Do these remain being challenges for an even greater boom of the market? What are the main characteristics of these green bond portfolios today, and how do you believe that they might change, including, for example, given the taxonomy that's coming out, commitments, as Joel mentioned, to transitioning to net zero? What are your views on these transitions?
Okay, thank you very much, Clarice. Yes, you're right. Diversification was a challenge in the early days. Selective was one of the first to produce, the first to produce a green bond index in 2014. And they were soon followed by other green bond indices, such as Bloomberg Barclays and Bank of America Merrill Lynch. And in those days, in 2014, and this is 7 years into the start of the green bond market, there were still only about 40 or so green bonds that were eligible for the indices. Even though we had sufficient issuance from utilities, for example, and real estate companies, there were very few in terms of, for example, autos and media. So diversification was a challenge from an industry sector point of view. But then we had subsequent issuance, and for example, Hyundai issued a green bond for the auto sector, and then Apple issued green bonds for the media sector. And so it has been possible to find the diversification that we're looking for. So now the constituents of green bond indices are in excess of 500 or so. So diversification isn't such a challenge as it was before. But similarly, liquidity was a challenge in the early days. That was until about 2012. And then that's when we had the first multi-billion-dollar green bond from IFC. And that was followed by multi-billion euro issues from EDF and NG. And that greatly helped liquidity as well. And then the green bond market had a boost to liquidity when sovereigns started to issue, particularly the Republic of France, which is about 28 billion euros in size. And so once we had sovereigns issues such as France and Belgium and the Netherlands, etc., liquidity increased all the more. So I wouldn't say that diversification and liquidity are challenges now for the green bond market, but also just echoing what was said about net zero. I think that again may encourage, those net zero targets may encourage more sovereigns to come to the market with green bonds. But in terms of risks, I would say the biggest risk to the green bond market at the moment is really in duration. So when green bonds first, or green bond funds were first launched, like the indices, they had a duration of about 4.5 years or 5 years, which was very similar to the average sustainable bond fund. But as you know, a lot of green bonds issued in recent years have been very long dated. So now the duration of a green bond index and funds tend to be in the region of 9 years, so it's very long. So this is very good when interest rates are actually going down. And you'll find a lot of green bond funds will be in the top quartile of the Morningstar performance tables. But when interest rates start to normalize and interest rates start to go up, then you will find that green bond funds theoretically will fall further in price faster than the average bond fund, which still has an average duration of about 4.5 years. So for me, duration is the biggest risk. But there are other developments, as you mentioned before. There is the EU taxonomy. There is also the TCFD, the Task Force on Climate-Related Financial Disclosure. That seems to be taken on board by most parties now. And they are major factors, and we may come on to that a little bit later today.
Thank you very much. Fascinating. I actually wasn't aware of the duration and how, you know, in the future, perhaps near, where we imagine, you know, interest rates can't continue to be as they are forever. Now, it'll be very interesting to see how that develops with regards to performance and the attraction of these bonds. Florian, I turn to you to, you know, in a similar context of what does it actually look like, right? So what do these Paris-aligned indices look like? We're not comparing them to the past, obviously, because they're still quite new, but, you know, what was it like to develop them? What were the challenges in terms of construction? How are they different from parent indices, you know, when we think of World and ACWI, for example, and do you anticipate already, you know, challenges, you know, of this basically being a V1 or perhaps a V2 of the index, and how that might develop in the near future?
Yeah, so to quickly address the challenges, I think mostly, and for the most part, it's been following the regulations coming out, you know, one after another, draft after draft. And basically you have a trade-off to face, which is you want to be working on these indices, but at the same time, you're committing major resources to the development, obviously, and the requirements kept changing. Yeah, so if I remember, the initial report of the technical expert group came out, and I think every index provider globally started working on these Paris-aligned and climate transition benchmarks. And then there was a consultation, and the feedback changed the outcome a little bit. And so, you know, as an index provider, you constantly need to adjust. And you also have a certain uncertainty in regards to points that are just not clear, because there's no regulatory guidance yet. You know, you have to live with what's written in the regulations, and sometimes there's a little room for interpretation left and right. So those are some minor challenges that everybody, I guess, was facing. But when you look at the results and you compare the methodologies of different index providers, you see that what the regulation and the regulator initially set out to do, which was to provide a standardized benchmark with a standardized set of rules that is still by the label on this benchmark. I think, at least in that regard, the regulator was successful, yeah, because you can see that the different methodologies, they are roughly the same in terms of the bigger picture, but obviously with a little deviation here and there. And in regards to your second question, how do these benchmarks look like? Yeah, and maybe I would like to take a a little step back and actually just give a brief overview for those who are not familiar already with the concepts. What is a EU Paris aligned benchmark? The key objective of such benchmark is that it reduces the carbon intensity 50% when the index starts in comparison to the parent index. And then what's even, I guess, more important and newer when you compare it to existing solutions is that you decarbonize against yourself by 7% on a year-to-year basis. So each year you decarbonize by 7%. And then you know, there are some basic limitations on the companies you can include. So the regulator asks you to, when you start out with a developed markets benchmark, you exclude companies involved in controversial weapons, UN Global Compact violators, and tobacco. You have some activity-based exclusions, which focus on extractors and miners of coal, of fossil fuels, certain electricity generators. And finally, and this is something that the regulator put in very recently, there's also a link to the taxonomy in the final draft, because the requirements asked index administrators to exclude any companies that violate the environmental principles that are highlighted in the EU taxonomy, which are, for example, climate change mitigation, protection and restoration of ecosystems, and so on. So basically, when you start out with a benchmark or with a parent index, you do these exclusions and then you reweight the securities in order to achieve a 50% reduction in carbon intensity versus the parent index. And then on an ongoing basis, a 7% reduction year on year. How do these benchmarks look like compared, like the end product in comparison to their parent indices? What we've seen in the market, I can speak for our benchmarks, but I've also kept an eye on other products in the market. In terms of the performance and the risk profile, these benchmarks look very much like their parent indices. Yeah. So the developed market or world Paris aligned index looks very much like the underlying world plain vanilla equity index. Yeah. As I said, similar return and risk structures, even in terms of the sectors and sector and country weights, you don't see many big deviations from the benchmark. Obviously, energy is I think the one point to highlight, because so many companies in this area are excluded by definition. Let's say the energy sector is not represented in these benchmarks, but apart from that, roughly at their weight compared to the benchmarks. And the same is true for countries. The reason for that, though, is not necessarily based on the EU requirements, but rather on the methodologies that the index providers decided to implement. And a huge part of that is obviously based on market feedback from asset managers, from investment banks, from ETF issuers, where basically the feedback was, okay, we want to implement these strategies, but can we do so with a minimal tracking error? Yeah, so, and when you construct these benchmarks, you basically add to the optimization that is required to build them. You add certain restrictions on the deviation of sector and country weights in regards to the parent index. So to sum it up, we see similar risk and return profiles, and those are mostly based on, you know, the specific methodologies that the index providers choose to implement, rather than the plain vanilla regulations that are put out there by the European Union. And last but not least, I've talked a lot about equity. This extends to the bond side as well, to the fixed income side, where these constraints that you implement on sectors and countries extend to rating buckets and maturity buckets, right? So if I look at our products on the fixed income side that are Paris aligned, that basically carry that label, you will see that they also, in financial terms and in terms of rating and maturity exposure, they look very much like the underlying parent indices. Yeah.
Very interesting, Florian. I'd be particularly interested in looking at the tracking error of all of these, because it seems that there are challenges there, but perhaps with a bit of creativity, there's you know, some strong similarities with parent indices. Look, I could keep asking questions for the whole evening, but apparently I must open the opportunity for participants to ask their own questions as well. The panelists have now given you a bit of a teaser of their views and the areas of action with regards to climate. So we now open the panel to the Q&A for participants. And with that, I turn over to Marie-Alix, who will moderate the Q&A. Thank you.
Thanks, Clarisse. Right, so we do have a couple questions lined up in the chat. So the first one is actually to Florian. What are the underlying data you consider to measure carbon intensity in Paris-aligned and climate transition benchmarks?
Sorry, I had to unmute myself. That's an excellent question, and I can speak to the data that Selective is using. We are working with a range. So in terms of measuring the carbon intensity, there are obviously, there's a whole ecosystem of data providers, you know, providing carbon emissions data. For some of our benchmarks, we are working, for example, with ISS, we are working with CDP, and the way you have to measure carbon intensities or to calculate carbon intensities based on the EU regulations is that you are required to include scope 1 and 2 emissions and divide them by the enterprise value, including cash, to end up with the carbon intensity. So that's the official definition. One very important point that comes up across different discussions that I have listened to and been part of is, well, what about scope 3 emissions, right? And that was, and I come back to the question of challenges that a couple of minutes ago. That was actually one of the major challenges and one of the discussion points that we had internally at the beginning when we were building these indices, because you are facing a trade-off in terms of scope 3 emissions, which is the measurement of scope 3 emissions is probably not as advanced as everybody on this panel would like it to be. So there are some limitations when it comes to scope 3 emissions data. And that is also why the European Union is only asking administrators of benchmarks to phase in scope 3 emissions over a 4-year period. Yeah? So you don't have to consider them right away. What we decided at Selective is that it's basically scope 3 emissions represent such an important part and maybe the biggest problem when it comes to global warming, and maybe the major part when you look at overall emissions, that we decided this trade-off has to go in favor of including scope 3 emissions. But that's certainly up to discussion and maybe even a philosophical question, depending on your point of view. But yeah, so that's definitely a challenge that remains, I guess. But also with the prominence of these benchmarks and the demand for them, with that comes, let's say, an increased focus on the measurement of emissions. Yeah.
Thank you. So our next question is from Monica. So the ICMA just launched earlier today, the Transition Bonds Handbook. What are your thoughts on the key aspects for building credibility for these instruments? How will they reconcile with AO's exclusion policies?
I can start if you wish. In fact, the credibility for me is not a problem, and our exclusion policies is very limited. In fact, we only exclude tobacco, some weapons, and coal, and non-conventional oil and gas firms. So it's very limited, and so transition bonds are welcomed. Because the transition needs to take into account the world as it is, not the world as we wish it to be. And for instance, there is a lot of debate around gas today in Europe and among asset owners as well. But gas could be, for, of course, a limited period of time during the transition period, could be part of the solution, not necessarily for the next 30 years, but for the coming 5 or 10 years, it's better to use gas than coal or oil. So just to take this example. So of course you can present yourself as very, very green by excluding a lot of assets and a lot of industries. But at the end of the day, I'm not sure that it would help a lot the transition period. So that to have this, there's a transition bonds, in my opinion, it's a good way to transition from the world we are in to the world we would like to be in the coming decades.
Thank you. Shall I just say something very briefly about transition bonds as well? Maybe first a couple of risks or possible negatives. I've heard it said that if an entity wants to issue a bond, why not issue a green bond rather than a brown bond? Additionally, I think with transition bonds, what is crucial is the time horizon. So one of the incentives for a transition bond is to actually see the entity or the corporate issuing the bond transition to become more sustainable. You know, if that time horizon is 20 years, then I think investors would be very reluctant to support it. However, if it was much shorter than that, shorter than 10 years, then I think there is some motive there for investors. But on the positive side, we're seeing increasing demand for what I broadly call sustainable bonds. And we're seeing an expansion of the sustainable bond range. So we have, yes, we have green bonds. We also have social bonds. We have sustainability bonds, but it's also broadening out to sustainability linked bonds and now transition bonds as well. And if a transition bond does have a meaningful impact, then why not? I'm sure there's a space for them alongside green bonds and others as well. And I think the question was also about exclusion. And some investors have very strong principles, and I wouldn't expect those investors, often faith investors, to compromise on their values. So it may well be that there are some transition bonds for some investors, but maybe not all for investors. Maybe there are investors for some of the transition bonds as well. But it very much depends on asset owners' own preferences. But the whole range of bonds is broadening out.
Thanks, Chris. So this next question is actually for Chris also. You mentioned green bonds are riskier via a long duration. Would this be somewhat leveled up by a quote unquote better climate ready underlying assets?
So yes, thank you for the question. Yeah, absolutely. So yes, I think we have to be mindful of all the risks, and I think duration is a risk we need to be aware of. But that risk can be hedged quite straightforwardly. And it's very right to highlight the climate characteristics of a green bond. in actual fact, it's very difficult to find another product that has so much transparency and impact. And as I said at the beginning, very difficult to find a green asset that has as much impact as a green bond. So these speak very positively for green bonds. And I certainly wasn't saying earlier, perhaps we need to avoid green bonds. On the contrary, we just need to be aware of the risks. Green bonds are a very attractive product as part of the challenge of addressing climate change.
Thank you, Chris. So our next question coming from the chat mentions that they actually feel that carbon intensity is a backward-looking indicator to assess the climate transition risk and could be misleading. So the question is, did institutional investors consider other indicators to assess the impact of a security on the portfolio temperature? For example, investments of companies in CO2 emissions reduction technologies.
I fully agree that carbon intensity is a backward-looking indicator, and that's why Caisse des Dépôts, but also other institutional investors like AOA members are rather on a forward-looking scheme, discussing with the companies about their own trajectory toward net zero target, according to the science-based target, according to some metrics and some scientific based indicators, which are different from one sector to another, of course. But for me, it's better to invest today in a company, perhaps at a high level of carbon intensity today, but fully committed to reduce it dramatically in the course of the next 10 or 20 years, than to invest in a company which has perhaps a good score today, but without any further reduction plan. And so we have to appraise on which trajectory each company is today and tomorrow.
Thank you, Joël. So next question in the chat is for Chris. What kind of an impact would the ECB's acceptance of sustainability-linked bonds as collateral have on these green assets?
Yes, thank you very much. So it's a good question. So the ECB's action is, of course, very supportive. We have to bear in mind that sustainability-linked bonds is still quite a small market. Only recently there were just a handful of issues, but they are growing, and this product is expected to grow further. It's more of a performance type asset. It's not a use of proceeds bond like a green bond or a social bond or a sustainability bond. There's no disclosure or transparency of the use of proceeds. However, the key performance indicators are a big incentive to help the organization or the company to transition again, like a transition bond. And this is what investors like to see. So there is space for this type of bond also. And it was a very positive move, perhaps a little bit surprising for the market, that the ECB backed this product. It wasn't a surprise that they backed this product because of the product itself, but because the product itself is in the early stages of development. But certainly it's very positive and very supportive, and it will help to lead for us to see more issuance going forward.
Thanks, Chris. So another question, this is for Florian. What were the challenges Solactive bumped into during its development, and how were those overcome to deliver an index that is a robust benchmark?
Thanks for the question. Quickly, and I think I mentioned this briefly before, that basically the main challenge was following the legislative process on the EU side, right? Which included draft and then another draft and another draft with in specific details, but obviously with quite a large impact on the side of index. Yeah. And basically with that comes an uncertainty of index providers with regards to compliance with the regulations. Sometimes, as I mentioned before, you know, there's just a little wiggle room left and right in the wording of these regulations, and so you basically have to engage and talk to your regulator, your local regulator. In our case, BaFin, to make sure your understanding is correct, to make sure your feedback is also being fed back to Brussels in this case. Yeah. So I would say that is basically that was the main challenge. I mean, eventually, if you look at the market, everybody was luckily able to overcome this challenge, and everybody was, I guess, in the end happy to having tracked this huge regulatory initiatives from the get-go. And so, but aside from that, there's obviously challenges involved around disclosures, right? So I guess from our conversations with clients, we basically see that, you know, the disclosure requirements that come with these new benchmarks, but also affecting other types of funds in the entire ecosystem. Those kind of disclosures, they are obviously a little painful in terms of, you know, in terms of operation. They may pose an initial cost, but hopefully, you know, in a few years time, we will look back and say, okay, this actually put us on the right track for the sake of transparency, yeah, in ESG related matters.
Thank you, Florian. So we do have time for just one more question. This one is for Joël. In the context of constructing a multi-asset class portfolio, how does an asset owner think about these different products and approaches, green bond versus PA portfolios? How do they compare on managing climate risk and on impact? And is there an arbitrage between the two, or are they perceived as complementary? I'm just going to copy the question in the chat so you can read it again.
Okay, I try to keep it short. In fact, we are, of course, in favor of niche assets like green bonds. Of course, the green bond market is increasing very rapidly, but as of today, it's still a minority part of the market. So we do invest in green bonds, for instance, and we invest a larger share than the market share, according to our climate focus asset management, of course. But we also have to invest in the rest of the assets. And I come back to what I said some minutes ago. We have to invest a part of our balance sheet on impact assets. Green bonds are part of them, but also solar funds, you can imagine a lot of them. But also in parallel, it's not contradictory, we have also to manage the rest of our portfolio and to help it to shift to a greener economy. And that's why the indice initiative is very interesting also, especially when it comes to the ETF and passive asset management. In Caisse des Dépôts, most of our assets are actively managed internally from a very bottom-up, I would say, quote-unquote, old-fashioned but efficient way of managing assets. But we see the growing development of passive asset management, and to have the possibility to rely on sound indices for passive investments which are indexed to Paris Agreement is very, very helpful, I think, for the broad range of asset owners.
Thank you, Joël. So we just have one last question in the chat that came in. Is it possible to participate, to work and organize on sustainability at a personal level, or is it only at the institutional level?
it comes to the problem institutional investment versus retail investment. And for the time being, institutional investors are in advance in comparison with the retail world. And it's not that simple as an individual to invest in a sustainable fashion, because even on the bank networks, there is no sufficient education on these risks. So that's an issue which worries more and more our regulators, and that's a good thing, to give the possibility to Mr. Anybody in the streets to know whether his financial investments are aligned or not, are green or not, and on a very sound basis to avoid any greenwashing suspicion.
Thank you, Joël. So I believe this concludes our Q&A session. Gabriel, the floor is yours.
It's time to conclude, and I would like to thank our panelists for sharing their expertise on these topics and answering our question. I have some clear messages from each of them, and some good takeaways. So first of all, that maybe that asset owners in charge of, because they are at the beginning of the chain of decision of investment, of putting some ambition, and they are in charge of buying or not the funds that are proposed. So that's why they definitely are at the inception of this shift towards something more sustainable in the future. Another one takeaway regarding the green bonds is the main challenges regarding the high duration of the green bonds. That means maybe it's time to issue some shorter duration, and if they want to handle some more normalization of interest rate, according to me, it won't be for tomorrow, but anyway, we never know. And so there is some room for shorter duration. And the last one is in for the indices. The main challenges remain on the data quality, and especially for the scope 3, and we need to open all the funds to a more broad data quality. I remind you that we hold a panel last week regarding this topic, ESG and data, and how the tech will bring some opportunity and some solution to that. So I invite you, for those who are interested, to listen the replay of this panel. So thank you, all of you. Thank you, Clarisse, for organizing this panel. Thank you for Marie-Alix for your support. And thank you, all of you, for attending this event. Rendezvous in January for the next one, ESG and Tech, Panel 2. It will be on models and rating consideration. I wish you a very good evening. Thank you. Bye-bye.
Bye-bye.
Have a good evening, everyone.
Very much.
Bye-bye.
Bye.